The Japanese yen has rallied about 5% over the last week after joint intervention between the BOJ and the US Treasury Department. And it has been, for the most part, the most widely discussed topic in financial circuits and financial circles and capital markets. We've talked a lot about Japan, the carry trade, the yen, as it relates to the overall milkshake theory that we kind of view the world through. And so I thought we obviously have to talk about it, and this week is the appropriate time to do so. So I thought what we would do is just I kind of walk through what happened, how they did it, why they did it, and what it could mean kind of going forward. Because whenever something like this happens, there's always a lot of breathless hot takes and hyperventilation over what is happening. And some of it's true. Not all of it is. And there's a lot of things that people get wrong. And so I'm going to do my best to kind of walk through, again, the whole topic from kind of top to bottom. And at the end of the day, I'm going to let you guys decide for yourself. But I think there's a lot of misconceptions that will help to be cleared up. So let's just kind of get into it here. At the end of the day, the yen had been falling for about 4 years now, and had fallen about 60% in the last 4 years. And so it went to 163 to the dollar, and the U.S. decided to step in and help prop it up. It's the first time that this has happened in 15 years, where Washington, or you can actually argue it's New York with the New York Fed's desk that actually does it, but bought yen alongside the Bank of Japan buying yen to strengthen the yen. And this is pretty rare. It doesn't happen very often. Hasn't happened for 15 years, and it happened for kind of a specific reason. And we'll get to that eventually. But again, it was at a 40-year low, and it's the last time, like I said, was 15 years ago. But the Japan has been doing all kinds of monetary shenanigans, for lack of a better way of saying it, for the better part of 25 years now. And they've started raising rates in the last few years. And despite that, the yen has stayed weak. And so I think that is what prompted Bessent to get involved. Bessent is the Treasury Secretary. This was done through the Treasury, not through the Fed. But that took it from 163 back to 155. Initially, I think it's around 157 now. So again, it's about a 5% move, which is a big move for a currency, especially a currency as big as the yen. But let's talk a little bit about how they did it, because though how they did it is a little different than they typically do as well. So typically a swap line would be used. And in that case, money would be extended, or actually yen would be pledged as collateral and pledged in an account at the New York Fed. And then the Fed would pledge dollars in an account for the Bank of Japan at the New York Fed. And then the Bank of Japan could take those and loan those out to its constituents, who could then, meaning the Japanese banks, and then those banks could go out and loan it to their constituents. But that was not done this time. What was done was actually where the Treasury went out and, through the Exchange Stabilization Fund, which is a tool of the U.S. Treasury, actually bought yen in the open market to strengthen the yen and weaken the dollar. Now, the interesting thing here is that the Fed did not buy it with dollars. In other words, it didn't spend dollars to buy the yen. It actually sold euros that the Treasury was holding in the Exchange Stabilization Fund, and they sold those to buy the yen. So they sold they sold euros to buy dollars rather than to buy yen rather than selling its own dollars. And they basically said that they would give access to the FEMA repo facility, where Japan could then, rather than selling U.S. Treasury bonds, could pledge those U.S. Treasury bonds at the FEMA facility and then get dollars that way as well. And again, the New York Fed, even though this is a U.S. Treasury operation, the U.S. Treasury doesn't have a bank. The Federal Reserve is the Treasury's bank. And so this was done via the New York Fed. So this wasn't really a Kevin Warsh decision. This was a Scott Bessent decision, in which case I would actually argue they're one and the same. But again, this was done by the New York Fed on behalf of the U.S. Treasury. And that in itself, that the Treasury is getting involved sends a very big signal to the market. So that gets us to jawboning, the power of the signal. And in many ways, the promise matters more than the actual transaction. The euros that were spent and buying the yen, that does have an impact. But the bigger weapon is the credible signal that Washington is going to step in again and again. And if you are a market participant, you have to have huge balance sheet and huge cojones to take on the U.S. Treasury. And so, Bessent actually gave an interview, and he even said this. He even said, we stand by Japan. It's a great ally. We have acted strongly here, and we will not hesitate to act strongly again. Now, let me ask you, if you have all your hard-earned savings saved up that you have toiled and for years to save, do you really want to bet against Scott Bessent, who has all the liquidity he needs in order to do this? Probably not. And the other market participants certainly didn't want to do it, at least not initially. And so that is why the yen rallied so fastly. And again, we didn't pledge any dollars, and the Treasury can repeat this whenever they want to. And it would be very hard for a market participant to go against them. Now, it's not impossible, and we will talk about that. But again, if you were short the yen because there's nothing they can do about it, and this is going to end up going to 200 and 300 and then 300, and you had it on with leverage, and the yen goes from 163 to 155, you get carried out. So shorting a currency that Washington has vowed to defend is extremely dangerous. So look, if you're trying to navigate these markets right now, you probably feel like you're flying blind half the time. Every time you think you've got a handle on geopolitics, the dollar, or rates, or whatever the central banks are doing, the whole picture shifts on you. And honestly, that's because most of the analysis out there is really just commentary where they just recycle the same surface level stuff everyone else is saying. We've put together something different. It's called the Research Shop, and it's where our institutional grade work is available. These are deep dive reports on things like sovereign debt pressures, currency mechanics, geopolitical disruptions, and realpolitik, the structural stuff that actually moves markets before the headlines catch up. We explain how the system actually works so that you can interpret the ever-changing headlines from a point of knowledge and understanding rather than from a point of awe and guessing what comes next. Each report comes with the full written PDF plus an audiobook version, so you can work through it however fits your schedule. It's a one-time purchase, no subscription, $249, and you own it for good. If you want to see what's actually in there, just visit santiagocapital.com and click on Shop to take a look at our offerings. Visit santiagocapital.com, and thanks for listening. You might lose all your money, and if you don't lose your money, but you lose the bank's money that you work for, that bank is going to fire you. So again, it doesn't mean that they can just do this for as long as they want, whenever they want, but it means they are the biggest person in the market, not even a person. It's the biggest institution in the world. And that is who you're going up against. And that is why market participants stepped away, at least initially. Again, we'll talk about that. But again, let's it was kind of unusual the way they did this. It'll be interesting to see what they do going forward because I think they will have to do it again, and we'll talk about why that is. They decided to do it through the ESF rather than through the swap line. And so, in a dollar swap line, as I mentioned earlier, the Fed lends dollars to a foreign central bank, in this case, the Bank of Japan, and they take the yen as the collateral. And then the bank in Japan uses those reserves, credits the banks in their jurisdictions accounts, and then those banks can then use it to loan out to the bank's clients that may need dollar funding. And this was a big deal back in 2008, where about almost $600 billion was extended via swap lines. And then again in COVID, about $450 billion. And this time they didn't do the swap line. And like I said, instead they used, they went directly into the market to buy it. There was no loan, no central bank counterparty. So these swap lines already exist. If Japan wanted to borrow money, dollars from the US, they could have easily just tapped that swap line. Now, they don't, when a country taps the swap line, it's not like they just do, they're going to call the Treasury before they do it. So there's going to be some communication, or they're going to call the Fed before they do it. And the Fed and the Treasury are going to talk. And in this case, for whatever reason, this is the way that Besant decided to do it. So this is the way they did it. But these standing swap lines, they already exist with 5 central banks. They exist with the European Central Bank. They work with the bank, obviously with the Bank of Japan, Bank of England, the Swiss National Bank, and the Bank of Canada. So these pipes, these facilities already exist. Why they chose to do it this way this time, I'm not really sure, but I would say it sends kind of a signal to Europe. If the United States kind of backhandedly says to Europe, we are going to sell your currency in favor of the Japanese yen, what does that say about where those two rank amongst priority? Again, it doesn't necessarily mean anything bad for Europe, but I'm sure the ECB was not thrilled with the fact that this is the way it went down. Okay, so I think this is part and parcel for the new way that the United States is dealing with the rest of the world. And we've talked about this several times. This is part of the change from the traditional strategy that the United States used to kind of manage the global monetary order and political order, from the rules-based order to America first, and a greater good scenario to a very transactional scenario. And I think under this new policy, whether I like it or not, whether you like it or not, it's a policy where we help friends and punish enemies. And so the carrot is, we will extend you dollar swap lines. We will help you via the ESF. We will give you preferential trade terms, whatever it is, in order to help you manage whatever challenges you are going through, right? And so if it's defending a currency is what needs to be done for whatever reason, then that can happen. If a trade deal needs to be extended or managed in a certain way, then that will be done. But in this case, they even asked Trump about it. And Trump said, Japan's been a very good friend, with the exception of Pearl Harbor. Yes, he actually said that. Excuse me for 1 second. He actually said that. But he said they'll always be there. And Besant said the same. And so this is an example of helping friends, and alignment gets rewarded. The flip side is, punish enemies. That's the stick, right? The same toolkit can be used against these countries that is being used, in this case, in favor of Japan. You can, in the same way that we can grant access to dollars, we can withhold it. And Besant has discussed this on a couple different occasions, how they have purposely done this. And the best case or the best current example is with Iran. But again, I think we are now, and listen, I'm going to stop and say this in case there's somebody new that's listening that hasn't listened before. I don't know that this is the right way to do it. It's certainly antagonistic. It's not as diplomatic as I would probably like it to be, but I think this is the way it is. And, it does it when you're analyzing what's going to happen in the future and how this is going to impact your portfolio. It's not that helpful for me to tell you how nice things should be and how this isn't, it should be done a different way. The best way I think I can help you is to tell you how I think it's actually going to go down, whether I want it to or not. And so that's whenever we talk about this stuff on this channel, we talk about what we think is going to happen, not necessarily what we want to see happen. And so I think increasingly going forward, we're going to see the Treasury and the Fed increasingly move as one entity. I think the rules-based order era is over. And I think in that previous order, you had all these different parts of the US government that may be working towards their own agendas. Maybe the State Department had certain goals. Maybe the Treasury Department had certain goals. Maybe the Commerce Department had certain goals and the Fed had different certain goals, but they were not always completely aligned. That's kind of been thrown out the window and everything is aligned now. And in America First, all hands on deck to help those who help us and to punish those who don't. And again, it's a very transactional, this is part of the reason we're having strife in the world. Part of the reason we're having volatility, although volatility has for the most part remained somewhat guarded. It's part of the reason we have everything going on with Iran, because we are moving towards a more transactional based system. And I think using the ESF, using these swap lines, using monetary policy is probably the best way. It's the best non-kinetic or non-military way for the United States to use statecraft to get what it wants. And at the end of the day, that's what countries do. Countries try to get what they want. And this is not unique to the United States. Russia tries to get what it wants. China tries to get what it wants. Countries in Europe, countries in South America, Africa, Australia, it's the same everywhere. And if you don't think it's like this, I would suggest that you do a little bit more thinking on the topic. I know people disagree with me on that, but this is my channel, so I get to say what I want. Anyway, so why now? Why did they do it now? This is not new. Japan's currency has been weakening for many years now. Like I said, it's down like 60% over the last 4 or 5 years, which when you think about a currency dropping 60%, this is what everybody always talks about is going to happen to the dollar. And yet, these problems are happening to other currencies before it is happening to the dollar. But from a technical perspective, 165 is a pretty critical level, because from there, you can gap higher pretty quickly. And I think a clean break above that, you risk starting to get a disorderly devaluation rather than just the slow drip devaluation that we have seen. And I think not the other part of the reason that they've done it now is for years, Japan's interest rates were either at zero or negative. And in the last year and a half, 2 years, they have finally started raising rates. And now the policy rate is at 1%, which doesn't sound like a lot, but when it used to be negative, that's come up quite a bit in the last couple of years. And if you raise rates and the currency continues to weaken, that's not a great sign. In fact, that is a really bad sign. And so the fact that it hasn't traded above 165 since the mid-1980s, over 40 years, if you get above 165, you could gap to 200 pretty quickly. And by the way, as the number is rising, that's the yen getting weaker. And so as things start to get disorderly, remember, I think the United States and the Fed and the Treasury, they probably don't mind the rest of the world being under pressure. But they don't want a global financial crisis. That doesn't help anybody. They want to be able to manage. I mean, the U.S. wants to stay on top. I don't think they mind conflict. I don't think they mind volatility, but they don't want a global financial crisis. Nobody wants a global financial crisis. So if they have these tools in place, they're going to use them. And it's kind of like if you're going down the hill and you're going pretty fast, you tap the brakes every now and then. rather than waiting until you were almost out of control and slamming on the brakes. So that's probably the right way to think about it. But they were probably getting pretty close to the edge and felt like they needed to tap the brakes pretty hard here in order to keep the whole thing on the road. But the highest that the yen ever got was, if we just go back to 50 years ago, was 360, and it went all the way from 360 to 75. Now, the part of the reason it went to 75 is when it was at 240. I think 240 is when they did the Plaza Accord and weakened the dollar artificially. And then as the dollar was weakening artificially, then the yen is strengthening, right? And that ultimately reached its strongest point in 2011, about 15 years ago, where it was at 75. So again, I think that is why now, as opposed to some previous times. And again, going back to what I was talking about, the interest rates, this chart up on the top right here, this shows the Bank of Japan policy rate since 2004. And you can see they've been steadily raising it for the last 2 years. And despite that, you can see when they first started raising it, the pink line is the yen. Despite them raising it, the yen still weakened significantly. And then they raised it a few more times and the yen backed off a little bit, got a little bit stronger. But now, over the last year, despite rate continuing to raise, the yen has, again, it got really weak. It got 163 and it started to, again, if you are implementing policies to strengthen your currency and you as a central bank are coming out and saying, hey, be ready for more, and it continues to weaken, that's not a good sign. And by the way, if I have not said this yet, I ultimately think this is going to fail. I've said this many times. I've written about it. We've talked about it on this show. I think the yen is going to 200 and I think it's going to go to 300, but it's not going to be a straight line and it's not going to be easy. And when that happens, all kind of hell is going to break loose. I don't know when it's going to happen. I just think that's where it ultimately ends up. That's part of the whole milkshake theory. But anyway, that's kind of where we're at now. That's why I think this is all happening now. So why should the part of the reason is because it's a very big deal. And it's not just a big deal for the US. It is a big deal for the US, and we'll get to why that is. But it's a big deal for the rest of the world as well. The reason is because Japan is the largest foreign holder of US treasuries. So when the yen lurches and Japan gets in trouble and they have to sell foreign assets, they're going to sell US treasuries. And if you sell US treasuries, then that can cause the yen to go higher. And if the yen does go higher, then you can get into a carry trade unwind. So Japan owns like $3.5 trillion worth of foreign assets, right? So a yen rally pulls that capital from around the world back into Japan. And that means if that money is flowing from the rest of the world back into Japan, it's leaving all those markets that it was in. And that creates potentially it creates liquidity problems. And then you get asset prices falling around the world. And with the US Treasury already at 4.6%, if the biggest seller starts selling more, then that can push the yields even higher. And you can see up again on the top right that Japan is by far the biggest holder. And so this is it. Okay. So why is that not just a problem for the United States? The reason it's not just a problem for the United States is the whole world funds itself in dollars. So as U.S. funding rates go higher, it doesn't just affect the United States. It affects the whole world. And so again, that's how you can get this carry trade underway. I should have covered this a little bit before, but the carry trade, the BIS, Bank of International Settlements, basically they measure the carry trade at like 700 or 800 billion. But even they have said that's very likely to be dramatically underestimated. And then there's other estimates out there that are in the tens of trillions. The bottom line is we don't really know, but we just know that it's big and it has the potential to be very disruptive. So again, this gets back to why now. But I want to address the whole United States thing because this is a problem for the United States. The United States does not want people selling their treasury bonds. right? They would prefer that everybody hold on to their Treasury bonds. The point I have always made, and if you go back to the very first time I ever mentioned the dollar milkshake theory, I said we are going to get to a point where interest rates are going to rise and treasuries are going to fall. And it's the higher treasury yields and lower treasury prices that makes the dollar stronger. It puts pressure on the rest of the world's currencies, and you end up having them having to fire sale assets. And when all the money flows out of sovereign bonds, two of the most likely places they will end up is U.S. equities and gold. So that's how you get the dollar going higher. That's how you get gold going higher. That's how you get U.S. equities going higher. And you get foreign bonds and foreign currencies falling. So this is right in line what we've always talked about. But they don't, again, the United States does not want the full milkshake theory to play out. And we'll get to that in a second as well. But I think that's what's going to happen anyway. And by defending the yen, they're trying to slow that process or try to manage that process, right? So it helps Japan in that way. But the way it helps the United States is it helps keeps the Treasury market from gapping down in price and gapping up in yield. And this is the other part I want to say. The very first line that I ever said when I first started talking about the milkshake theory is this is not a story that ends well. This will eventually end very, very badly for the United States. It's just that it doesn't hurt the United States as bad as it hurts everybody else initially. So it gets to be this circular bailout. Is the United States bailing out Japan? Yeah, but are they bailing out Japan because it also bails out themselves? Yes, but are they bailing out themselves because by bailing out themselves, it actually bails out the whole world? Yes, they don't want a global crisis. So they are going to use all the tools they can to keep the plates spinning. And that is what's happening right now as we are moving forward in time and interest rates are rising and all the debts in the world are becoming more cumbersome. And we are no longer trading the way we used to. And we are no longer cooperating the way we used to. All the plates that are spinning are getting more unstable and they're going to start to fall. And this is the U.S.'s attempt to keep the plates spinning. And they're doing that in cooperation with the central banks that they like. And they're doing it in opposition to the central banks they don't like. So if you want to call it a circular bailout, I'm not going to disagree with you. That is what's happening. But the point is no side can afford for this to happen. Now, that doesn't mean it won't happen anyway, but nobody wants this to happen. Believe me, emerging markets do not want the U.S. Treasury yield to go to 7%, because if so, they are going to have a very difficult time getting funding. And that's kind of what I was making here. James Lavish, who I get along with great, and I think he's a super smart guy, he said, make no mistake, the U.S. Treasury teaming up with the Bank of Japan is not to merely help the yen or other Asian currencies. It's to protect U.S. Treasuries. Why? Because if the BOJ is left to stabilize and support the yen themselves, they will have a little choice but to sell U.S. Treasuries. He's absolutely right. My point is that it is not just to protect the United States. It's not just to protect Japan. It's to protect the entire system because the entire system is integrated. There is never going to be any scenario where U.S. Treasuries get sold, the United States goes into some fantastically horrible recession, and the rest of the world benefits from this. And the rest of the world has a picnic while the United States burns. It just doesn't work that way. And I will continue to pound my fence on the table to get that point across. And so my point was it's to protect the entire global system. If 10 to 30 U.S. Treasury yields jump to high single digits, it will hit emergent and developing markets and all other even developed markets harder than anyone. And part of the reason is if that starts to happen, the U.S. can print the chips that are needed to continue in the game. No other country can. And does printing the dollar end up hurting the dollar in the very, very, very long term? Yeah, it does. But in the short term, they would be printing dollars to keep it from spiking. So again, there's a progression, and it's really important to understand the progression. If the United States wouldn't have to print more dollars if nobody wanted them, but the reason they would be responding to a global margin call on the dollar. So again, that's why I think it's important to understand the whole dynamic and how the whole system is interrelated. And this is because the whole world uses dollars, and corporate debt all over the world, and even sovereign debt to a certain extent, is priced off of the 10-year US Treasury. That is in all financial models and in all discounted cash flows and in all projections and valuation methodology around the world, the 10-year Treasury is the risk-free rate, and then that prices all deals off of that. So when it gaps higher, every bond on earth reprices with it. If it hurts the US, it's going to crush everybody else. Part of the reason the rest of the world has $13 trillion of US dollar debt, but that's just the on-balance sheet bank debt. The same Bank of International Settlements did an analysis a couple years ago, and they said the number's over 80 trillion when you start to talk about shadow banking and off-balance sheet liabilities. And so if you are a global bank and you can get 8% for holding the US Treasury, why would you hold a Turkish Treasury that pays 7, or an Egyptian sovereign that pays 9, or an Australian sovereign that pays 8? When you don't need those on the global stage, but you do need dollars on the global stage. So again, this is all interconnected. You're not going to have US Treasury rates spiking and all other sovereign bonds in the world are going to be fine. And we've talked about this. People say this is unexpected for the milkshake theory. No, we actually did a big report on this a couple of months ago. It was called The Band. We even had a specific chapter in the report called Sympathy for the Devil, because sympathy for the devil goes over what happens when they lose control. Now, again, the point we've tried to make is these tools exist for a reason. They are there for the U.S. administration, whether it's Fed or Treasury, to try to manage the overall situation and to keep the plates spinning. We think they have a lot of tools that they can use. We think they're better at using them than many people give them credit for. But at some point, they will lose control. At least that's my belief. And if they do, we think it will have a certain effect on not only the United States, but the rest of the world. And we specifically go over that in the Sympathy for the Devil section of that report. And so again, all these tools that they have, this is not, they're going to use them. I can think of 5 different tools off the top of my head. This is not just charity for Japan. It's a defense of the entire system and the whole world that the whole world runs on. And Washington has the tools to do it. The Exchange Stabilization Fund was used this time. They have the FEMA repo facility also set up. They have central bank swap lines. They can do coordinated interventions, and they can also just do the verbal interventions. And the verbal interventions has worked really well, both in Japan and Argentina over the last few years. Now, again, for those saying they can't do this forever, I completely agree with you, but I think they can do it longer than many people think they can. And, we've seen this done in 2008. We saw it again in 2020, and now we see it again in 2026. Different tools have been used, but so far it's been pretty effective. So for those who are skeptical of this, believe me, I completely get it. It's a crazy, messed up system. Nobody in their right mind would ever design a system this way, but they did. And this is how it is. And transitioning from this system to another system would be extremely volatile. And no government wants extreme volatility, because that's how governments end up going bye-bye. So they don't want that. So I think the objections to this would be they don't know what they're doing. They're overwhelmed. They're unprepared. And if they don't understand what they're dealing with, and the whole thing is going to fall apart, and it's going to fall apart now. And I would answer, just check out the record before you make that conclusion. The tools are already there and built. So if they're already there and built, how can they be unprepared? In other words, if they're clueless and don't have any idea what's going on, why did they already have these tools in place? Why were these programs designed and put in place years ago if these guys had no idea they might need to be used? The other thing I would say is Bessent ran a macro fund for a long time. Not only did he run a macro fund for a long time, but he knows some of the biggest legends in history. Not only that, he worked with some of the biggest investment legends, and he was on the team that broke the Bank of England. So I think maybe he might understand some of these dynamics a little better than some of the people on Twitter. I don't think this is amateur hour. Now, to be clear, this doesn't mean it will work. It doesn't mean they are guaranteed to succeed, but these are not idiots. And the more you think that they are, the less of an advantage or the bigger a disadvantage you're going to put yourself at. So none of this means they win forever. It's going to end badly in the end. It's just not going to end yet because at the end of the day, markets are more powerful than men. But it's not going to be a straight line. And if you bet on the straight line, you're probably going to get carried out on your shield at some point. And so, I was just with my buddy Michael Nicolitos this last week. We were at Hugh Hendry's Asset Capitalist Summer Camp, and he and I were talking about this the whole time. And then he tweeted this out yesterday. And I'm not going to read you the whole tweet. It's truncated here. But he basically said on the yen swap lines and the noise machine, and given the level of absurdity circulating on X about the yen situation, a few facts are in order. And then he goes on to explain all these. I would highly recommend you look up Michael and read his full post here. And at the end, I retweeted it and I said, this is like poetry. And I was referring to his last few sentences. And I'm just going to read him here. And he says, which brings me to the final point. Everyone on X seems convinced they have figured out something that all the PhDs at the Fed and the Treasury Secretary, who probably understands capital markets better than almost anyone else, having worked alongside the greatest macro minds in the past century, somehow have missed. That is at best hubris, and at worst, it's stupidity. So a lot of times people accuse the Fed and the Treasury and the governments and the powers that be of being very arrogant, lots of hubris. And then I would argue that the people making these comments are often guilty of the very thing that they are talking about, and in many ways are projecting the very thing that they are doing. And I think Michael very succinctly brought that up here. Do not underestimate these people. It will be to your detriment. And then, the other thing I would say is we're talking about the problem of U.S. Treasuries being sold. But the reality is U.S. Treasuries holdings by foreign entities has never been higher than it is today. But they've been selling Chinese Treasuries for the last 3 years. Richard Casey, who I strongly advise you to follow him as well, because he's somebody who has actually been in these markets for decades, made this point. He said the future global reserve currency, he's being facetious here, foreign holdings of Chinese government debt down almost 30% since 2004 to under 500 billion. Meanwhile, foreign holdings of U.S. Treasuries near all-time highs of over 9 trillion. So again, this is a relative game. Some people might not like that it's a relative game, but it's a relative game. And the fact that some treasuries are getting sold, but the fact that the United States has some tools to deal with it, I think makes them in better shape than many of its adversaries. Okay, last thing I would say, with all of this uncertainty and the fact that this is eventually going to end badly, and the fact that even though these financial experts have these tools at their disposal, at some point it may get away from them. I've always been a big promoter of gold, and I think owning gold as a cornerstone of your portfolio is something everybody should do. And it's why I joined the board of Monetary Metals, because I think in addition to owning your physical bullion, in addition, I would argue owning physical bullion is extremely low risk. But many people either own physical bullion or they own mining stocks. I would say mining stocks are high risk. But sitting in between there, it's a wide open field, and nobody is in there except for Monetary Metals. And it's a way to own gold and earn a yield on gold. And it's a way to put gold to productive use in the system and try to use gold as money. I have people tell me all the time that gold is money, but then they refuse to use it as money. If you go to monetary-metals.com/Santiago, you can learn more about it. I suggest you guys do that. I have an account there. I add money to it every month, and I think that you should consider doing the same thing. It's a low risk end, a high risk. There's a low risk end, there's a high risk end, and there's a wide open middle. And I think monetary metals sits right there in the middle of it. Finally, if you like this type of topic and you like to hear these types of issues discussed, please go to research.santiagocapital.com. You can find our different offerings there, which you can get the written updates of these shows, as well as many other reports that we put out on a pretty regular basis. And if you don't mind, hit the like button, hit the subscribe button, and hit the retweet button. I'm told that all of that stuff helps us grow the channel to where we can bring more of this information to you. Okay, that went on about 10 minutes longer than I expected, but I hope that was helpful. Remember, whenever these types of things happen and people are going crazy and, giving your hot takes one right after the other, take a breath, step back, think about all of this in a calm and reasonable manner. Usually it's not the disaster that Twitter would make it out to be. Okay, guys, catch you next week.